Rafi, is it time for you? Are you able to see the board? Students, how are you all? Fine? Good? Good morning, my online students.
Good morning, ma'am.
Good morning.
How are you, Ajrika? How are you, everyone?
How are you?
I'm fine, thank you. Okay, my dear students, as you do know that in our last lecture, we finished our discussion at IS 40. IS 40 investment property was under discussion, and we had ended our discussion while we were on the last part of investment property. IS 40 is very similar to IS 16 and IS 38. Whenever we are studying, whenever you will be studying also, try to do these standards collectively. IS 16, IS 38, and IS 40. Because these three are similar standards. All these standards are based upon the non-current assets. IS 16 is for tangible non-current assets, IS 38 for intangible non-current assets, and IS 40 is again for tangible non-current assets, but it is related to the investment property. We had discussed about the definition of investment property, all of that kind of a property which the organization or a person or an individual is purchasing for the purpose of the capital increments or for the purpose of giving it on rentals is known as an investment property. Any kind of property which is purchased for the basic purpose of getting a capital increment, that say, for example, after some time period, the property value is going to be increased and we are going to save it to generate capital increment is known as an investment property. On the other hand, sometimes we are purchasing a property so that we can give it on rent and we can earn rentals out of it. So that kind of property is known as an investment property, and that property would not be dealt within IS 16, but we are going to deal it within IS 40. Now, we had discussed that initially, when we have to measure an investment property, it will be measured on cost basis. We are going to measure initially the investment property on its cost. That is a similar point which we have discussed in the case of IS 38 and IS 16. IS 38 is yet to be discussed, okay? But in F3 we have already discussed. So it's similar that initially we are going to measure the investment property at its cost. And under cost, what do we include? Purchase price plus all the costs which were necessary to bring the asset in its present location and condition. So initially, in the first year of the purchase, we are going to recognize the investment property in our statement of financial position at its cost. Then subsequently, after the first year of the purchase, we have been given an option by IFRS, International Financial Reporting Standards, that we can either adopt a cost model or a fair value model in order to recognize our investment property. So in the first year of the purchase, we have to recognize our investment property at its cost. Subsequently, after the first year of the purchase, we are having two options. Either we can recognize our investment property at its cost, or we can recognize it at its fair value. So two models are there. Over here, the distinguishing factor arises. Here is where there is a difference among three standards. Those three standards are IS 16, IS 38, and IS 40. In IS 16, the two models which are given to us are cost model and very good revaluation model. Under IS 38, we have cost model and fair value model, but we are going to adopt it in a different manner. Under IS 40, we have cost model and fair value model. When we are adopting a cost model, then the investment property has to be recognized at its cost minus accumulated depreciation, minus any kind of impairment losses. If we are adopting a fair value model, then we have to recognize our investment property at its fair value. And fair value is the market value of the property basically, or we can say the sale value of the investment property which we can get in an arm's length transaction. So fair value is the one at which we have to recognize the investment property subsequently while we are adopting fair value model. But when we are adopting a fair value model, no depreciation will be charged on the investment property. So this is the huge difference. This is the main distinguishing factor among fair value model and revaluation model. So when you are adopting a fair value model under IS 40, good morning, dear. When you are adopting a fair value model under investment property, you should keep in mind that no depreciation is going to be charged. So this was an overview. Hi, Sharika. Now, students, today, what topic we are going to start under IS 40? Please do. Good morning. Is that sometimes we are recognizing our assets under IS 16, and then we change our standard to IS 40. That is where we are shifting from IS 16 to IS 40. Say, for example, we had purchased some property, plant, and equipment to be used within the business for the purpose of earning economic benefits. Now, during the year, we have shifted that particular asset by giving it for rental, and obviously our main course of the business has now changed. So this is where we are shifting from IS 16 to IS 40. What are we going to do in that regard? Sometimes the opposite case happens. We are recognizing our property, plant, or equipment under IS 40, and because we were giving the property, plant, or equipment for rentals, but now we have started using that particular property, plant, or equipment in our own business to generate economic benefits. So both the cases can happen. Sometimes we are shifting from IS 40 to IS 16, and sometimes we are shifting from IS 16 to IS 40. So what are we going to do when we are having this kind of a situation? Let's have a look at the slide. They are telling us if an asset is transferred from property, plant, and equipment to investment property. The first case is that when we are shifting from IS 16 to IS 40. This is the first case. If an asset is transferred from property, plant, and equipment to investment property, and the fair value model for investment property is used. Now, under IS 40, we are using a fair value model. What are the prerequisites of the fair value model? That we are going to recognize our asset on its current fair value, and we are not going to charge any kind of depreciation. So if this is the case that we are shifting from IS 16 to IS 40 and fair value model of IS 40 is being used, then what should we do? They say the asset must first be revalued as per IS 16. In that case, first you are at the time of shifting, you are going to recognize your asset as per revaluation model of IS 16. Why do you have to do that, students? if you are recognizing your assets under IAS 16, and if there is a revaluation model, the revaluation gain has to be recognized where? In statement of other comprehensive income. Do you remember? Under IAS 16, if revaluation model is being used and there is a revaluation gain, that revaluation gain is recognized in statement of other comprehensive income. So at the time of shifting from IAS 16 to IAS 40, if there has been any revaluation gain, that one is going to be recognized in statement of other comprehensive income. What is the difference under IAS 40? Where does the revaluation gain goes? In statement of profit or loss. Okay, that you have to keep in mind. That is very important. That is going to be tested in your examination. In every exam, this point is being tested. So when you are shifting from IAS 16 to IAS 40 and fair value model of IAS 40 is being used, then at first you have to recognize your revaluation gain in statement of other comprehensive income as per IAS 16. So first thing what you have to do, if fair value model is being used, what you have to do? First, recognize revaluation gain as per IAS 16 in statement of other comprehensive income. This is what you have to do. And the second thing what you have to do, and then transfer into investment property at fair value. What you have to do secondly, after this step, secondly, transfer the asset to IAS 40 at its fair value. This is what you have to keep in mind. You can follow this flow chart in order to recognize the things. So when you are shifting from IAS 16 to IAS 40 and fair value model under IAS 40 is being used, then at first you have to recognize the revaluation gain in your statement of other comprehensive income, and together with that you are going to take that revaluation gain in your revaluation surplus asset. And then what you have to do secondly, that you are going to transfer the asset to IAS 40 at its current fair value. And what is fair value? It is normally the market value of the asset, the value at which the asset can be purchased or sold in a market. Now, what is the other case? If you are shifting your asset from PPE IAS 16 to IAS 40, but under investment properties, cost model is being used, then what you have to do? What you should have to do? What do you think? And where would the difference be? If fair value model is being used, there is no depreciation. But if cost model is being used, there must be a depreciation. So this is what now they are telling you. The asset is transferred into investment properties at current carrying amount. What is carrying amount? Cost minus accumulated depreciation is our carrying amount. So they are telling us the asset is transferred into investment properties at current carrying amount and continues to be depreciated. Under this case, no depreciation. But when you are seeing that under IAS 40, the cost model is being adopted, then what you have to do? Asset will be transferred at current carrying amount and continues to be depreciated. So this is what you have to keep in mind. Either they are going to tell you that from IAS 16 the transfer is to IAS 40, or they will be asking you for the second case where the asset will be transferred from investment property to the property, plant and equipment, and that is our second case. When from IAS 40, IAS 16 is going to be adopted, then what we are going to do? First have a look at that once again, and then we are going to discuss the second case. Under IAS 16, students, what do we do? Initially, the asset is measured at its cost. Cost is initial purchase price plus all the costs which were necessary to bring the asset at its present location and condition. Subsequently, after the first year of the purchase, we have the option that either we can use a cost model or a revaluation model. Under a cost model, the asset has to be recognized at its cost minus accumulated depreciation minus any subsequent impairment losses. If we are using a revaluation model under IAS 16, then the asset has to be recognized at its revalued amount minus any subsequent accumulated depreciation minus impairment losses. Under IAS 40, initially we measured the asset at its cost. This thing is the same as per IAS 16 also. Subsequently, we measured the asset either by using cost model or by using fair value model. If we are recognizing the asset using cost model, then the accounting is going to remain the same. Cost minus accumulated depreciation minus any kind of subsequent impairment losses. But if we are adopting fair value model under IAS 40, then we are going to recognize our investment property at its current fair value, and we are not going to take any kind of depreciation under fair value model. This is what we have done. If we are shifting during a year from IAS 16 to IAS 40 and under IAS 40 fair value model is being used, then at first we have to recognize any kind of revaluation gain under IAS 16, because under IAS 16 revaluation gain is recognized in statement of other comprehensive income. So first, at the time of shifting, if there is any revaluation gain, it will be transferred to statement of other comprehensive income, and together with that, it will be reported to the revaluation surplus in our statement of changes in equity and SOF. Secondly, what we have to do, we have to transfer the asset to our investment properties at its current fair value, and no depreciation will be taken on. If, say, for example, we are shifting from IAS 16 to IAS 40 and under IAS 40 cost model is being used, then we have to transfer our asset at its current carrying amount. Carrying amount is cost minus accumulated depreciation, is it? And afterwards, it will be continued to be depreciated. Clear, everyone? Now, see the second case. If we are shifting from IAS 40 to IAS 16, what is going to happen then? They are telling us if an asset is transferred from investment property to property, plant and equipment, and the fair value model for the investment property is being used. And in that case, if for IAS 40, fair value model has been used, then revalue the property first as per IAS 40. Then what we have to do? First, we have to revalue the asset. Revalue the asset as per IAS 40. What is the difference in revaluing the asset as per IAS 16 and revaluing the asset as per IAS 40? Under IAS 16, when we are revaluing the asset, we have to take the revaluation gain to statement of other comprehensive income. And if we are revaluing the asset under IAS 16, then we have to take the revaluation gain straight away to statement of profit or loss. This is what they are telling, that revalue the property first as per IAS 40, taking the gain or loss to the statement of profit or loss. So gain or loss, take gain or loss to statement of profit or loss. Over there, we have taken the loss or gain to the statement of other comprehensive income. So, and then transfer the property, plant and equipment and the fair value. So what is the second step? Secondly, transfer the asset at fair value. This is the same as we did over there also. Secondly, we are going to transfer the asset to our IAS 16 on its current fair value. But what is the other case? If the cost model is used for the investment properties, what we are going to do? If, say, for example, under IAS 40, we had been using cost model, then a very simple adjustment we have to do, that is the same as we did over there. The asset is transferred into property, plant and equipment at its current carrying amount and continues to be depreciated. So in that case, what we are going to do, we are going to transfer the asset at its current value, carrying value and continues to be depreciated. And these adjustments are necessary to be learned because these are going to be tested in the examination. My online students, read the slide once again and see if you are cleared or not. The students, what we have discussed in the first case, we have discussed if we are shifting from IS 16 to IS 40. If we are shifting from IS 16 to IS 40 and under IS 40, fair value model is being used, then first what we have to do, first recognize revaluation gain as per IS 16 in statement of other comprehensive income. Then secondly, take your asset to IS 40 at the current fair value and it will not be depreciated. If on the other hand, under IS 40 cost model has been used, then you have to shift the asset at its current carried value and then it continues to be depreciated. In the other case, if we are shifting from IS 40 to IS 16 and under IS 40 fair value model has been used, then first revalue the asset as per IS 40 and take the gain or the loss in statement of, take the gain in the statement of profit or loss. Because impairment loss, if it is a revaluation loss, it will be taken straight away to SOPL in all the cases. And if say, for example, under fair value model, the second option is being discussed, then secondly, we have to transfer the asset at its fair value. But if in the case for IS 40, the cost model has been used, then transfer the asset at its carrying value and it continues to be depreciated onwards. Now students, let's have a look at this understanding. We are going to practically apply it. The requirement of the question is that what amount should be recognized in Kyle Company's statement of profit or loss for the year ended 31st December 2001. So in the statement of profit or loss, you have to tell that which amount is going to be recognized for the year ended 31st December 2001. If the year ending date is 31st December 2001, the year starting date is 1st January 2001. Let's have a look at the question. Kyle Company purchased an investment property some years ago and carries it under fair value model. So investment property IS 40 is currently in use and under investment property fair value model has been used. At 1st January 2001, at the start of the year, the property had the fair value in Kyle's company's financial statement of $12 million. So the fair value at the start of the year has been $12 million. On 1st July 2001, in the middle of the year, on 1st July 2001, Kyle Company decided to move into property and use it for its own business. So this is a shift from IS 40 to IS 16. Which case we are going to use? That one. IS 16 to IS 40 we are shifting in the mid of the year. So when in the mid of the year we are shifting, obviously the adjustments will be started at the mid of the year, not from the start of the year. So on 1st July 2001, Kyle Company decided to move into property and use it for its own business. At this stage, the asset had the fair value of $14 million. So at the mid of the year, we can see that the fair value of that particular asset was $14 million and the remaining useful life is 14 years. What we are going to do, students, When we are shifting from IS 16 to IS 40 and under IS 40, fair value model has been used. That is the same case over here. Under IS 40, which model has been used? Fair value model has been used. So first what we have to do, first recognize revaluation gain as per IS 16 in statement of other comprehensive income. At the time of shifting, was there any revaluation gain? At the time of the shifting, in the start of the year, the fair value has been 12 million, but at the time of shifting on 1st July 2001, the fair value is $14 million. So there is a revaluation gain of how much? $2 million. So $2 million is going to be recognized in statement of other comprehensive income. This is the first treatment in statement of profit or loss and other comprehensive income. And what should we have to do? Second, transfer the asset as per IS 40 at its fair value. Now we will start recognizing the asset at which value? At $14 million. $14 million in SOFP. Although it is not being recognized to show the treatment in SOFP, but you should be knowing that afterwards, when we have started adopting IS 40, we will start recognizing investment property at 14 million. Got it? Are you clear up to here? Now, what is going to happen afterwards? This 14 million, is it going to be depreciated? Is it going to be depreciated? Who says no and who says yes? Is it going to be depreciated?
Useful. That's a useful life. It will be.
Sorry?
Has a useful life for 14 years, so it will be depreciated, right?
Okay. One mistake we did, and one big mistake we did, and no one has told me. Are we shifting from IS 16 to IS?
The search you said from IS 40 to 16, but now you said.
Yes. So over here we have to recognize. Over here we have to recognize because we are shifting from IS 40 to IS 16. Very good, Ali. From IS 40 to IS 16 we are shifting. So the treatment is going to remain the same, but one difference is going to arise. Are we going to take depreciation now? Are we going to take depreciation?
The current.
Under IS 16, do we have depreciation for revaluation model? Is it? So we are going to take depreciation now. That treatment is going to remain the same. We are going to recognize $2 million in our, where are we going to recognize it? SOPL. And what we are going to do, and when we are going to transfer the asset, it is going to be transferred at its current fair value. Current fair value is $14 million. Is it, students? This is $14 million. And because we have shifted from IS 40 to IS 16, now obviously we have to take depreciation as well. So how much depreciation we are going to take? The useful life, the remaining useful life is 14 years. And the current fair value is 14 million. So how much depreciation would be there? 14 million divided by 14 years. 1 million per year depreciation charge would be there. Is it? Are we going to take this full year depreciation charge? No. When was it shifted? It was shifted on 1st July 2001. So only half year depreciation is going to be taken. At the time of shifting, the revaluation gain on 1st July 2001, which was going to be taken to the statement of profit or loss, is 2 million. And afterwards, when we are going to start depreciating our asset, for the first year, we are going to take only half year depreciation since the asset has been transferred only on 1st July 2001, that is the mid of the year. So not this full 1 million, but 50% of it, or multiply by 6 divided by 12, depreciation will be taken in the 31st December 2001 statement of profit or loss. Okay, so we are going to take only 500,000 or 0.5 million of depreciation in our statement of profit. Have a look at this question, students, again, and tell me if you are clear on. So that is the shift from IS 40 to IS 60. Yes,
Why are you
student.
dividing by 12 instead of 6?
Sorry?
Why are you dividing by 12 instead of 6?
Multiply by 6 divided by 12. Because the full year depreciation is for 12 months and we are taking for 6 months. This 1 million depreciation is for full year. When we are dividing 14 million fair value with 14 years, we are getting a full year depreciation charge. But we have to take only 6 months depreciation charge. So divided by 12, multiply by 6. 0.5 million or 500,000. If this would have been a shift from IS 16 to IS 14, then no depreciation. Then obviously you should not be taking any depreciation. Since we are now transferring to IS 16, that is why the depreciation has to be taken. Because under IS 16, even if it's cost model or the revaluation model, in both cases we have to take depreciation. So only for 6 months we have taken depreciation. If it has been a shift from IS 16 to IS 14, instead of taking the 2 million revaluation gain in statement of profit or loss, we would have taken it to statement of other comprehensive. That is the second difference. Okay. Yes, my online students, are you cleared?
Yes, miss.
Okay. Shall we move on?
Yes, miss.
Now, students, we have another understanding that is related to full chapter. Not just related to IS 40, I feel, but it is related to full chapter. Let's start with this. The requirement of the question is show using extracts the correct financial reporting treatment for the above items in the financial statements for Hudson for the year ended 30th September 2003. If the year ending date is 30th September 2003, then the year starting date is 1st October 2002. So our accounting year is 1st October 2002 to 30th September 2003. Is it? Let's start reading the scenario. We have to record the financial reporting treatment in the case of SOPL and SOFP both. Okay, during the year to 30th September 2003, Hudson built a new mining facility to take advantage of new laws regarding onshore gas extraction. The construction of the facility cost $10 million. And to fund this, Hudson took out $10 million 6% loan on 1st October 2002. Obviously, we have to record the treatment in SOFP and SOPL both. That is why in SOFP, we have to record the cost of the asset. Is it? So when they are telling us that the construction of the facility costs $10 million, is it going to be included in the cost of the asset? Construction cost? All the costs which are necessary to bring the asset in its present location and working condition. So construction cost is going to be included in the cost of the asset. So in the cost, we are going to include construction cost. Is it? How much it is? $10 million. And to fund this, Hudson took out a $10 million 6% loan on 1st October 2002. This which standard is being used over here? Borrowing costs, IS 23. Like this in the examination, they are going to test different standards in the same question. So borrowing cost IS 23 is starting to be applied over here. The construction of the facility cost $10 million. This is IS 16. And to fund this, Hudson took out $10 million 6% loan on 1st October 2003. That is IS 23 borrowing cost. So IS 23 borrowing cost says that whenever you are taking any amount of loan in order to construct or purchase or acquire an asset, the particular cost can be, the particular interest cost can be added to the cost of an asset if certain criteria is being met. When you are taking a loan, only the loan which is taken during the construction or the acquisition of the asset is going to be capitalized. The interest on that loan is going to be capitalized only during the construction time period. The pre-construction and the post-construction interest on loan is going to be revenue. Is going to become a revenue expenditure. So this is the condition. So they say they took out loan of $10 million, 6% on 1st October 2002. At the start of the year, they have taken a loan, which will not be repaid until 2006. The 6% interest was paid on 30th September 2003. So no worries, we have taken the loan at the start of the year and we are paying the interest at 30th September 2003. Is it? So under IAS 23, let's do this treatment separately and then we are going to add the interest cost in our cost. So IAS 23, interest paid, which is going to be capitalized. Up to the information which we have read, the interest which has to be capitalized is 10 million multiplied by 6% for full year from 1st October to 30th September 2003. Is it? Then they say the 6% interest was paid on 30th September 2003. Construction work began on 1st October 2002. Okay, so our next query is also being resolved. Soon after taking the loan, the construction had been started. So there is no pre-construction interest on loan which needs to be deducted from the capital. Okay, so they say the construction work began on 1st October 2002 and the work was completed on 31st August 2003. So it has been, construction work has been started on 1st October 2002, but it has been ended on 31st October, August 2003, which is much before August. Yes, only 1 month before the year ending date it has been completed. So how much interest is going to be capitalized? Only for 11 months. Is it? October, November, December, January, February, March, April, May, June, July, and August. Only for 11 months, the interest on the loan is going to be capitalized since the construction work has been completed by 31st August 2003. So out of it, only 11 months interest is going to be capitalized, multiplied by 11 divided by. Sorry? Yes, it's till August, from October to August, 11 months. Okay. On 1st October, we had taken a loan and soon after that, our construction work had been started. But construction had been ended on 31st August 2003. That is why we cannot capitalize the remaining interest, is it? And remaining 1 month interest will be going to the statement of profit or loss as per our finances. So we can write that as well. In SOPM, our remaining finance cost of how much is going to go? 10 million. Multiplied by 6%, multiplied by 1 divided by 12. This will be going to the statement of profit or loss. And this one will be going to the cost of the asset in SOF. Got it? Okay, let's see. And the work was completed on 31st August 2003 as not all the funds were required immediately. Hudson invested 3 million of the loan in 4% bonds from 1st October 2002 until 31st January 2003. Now, at the time of the taking loan, Hudson saw that we are not going to need the funds immediately. So he had invested few funds in the 4% bonds. This is the interest income. Out of this total interest income, we can deduct it from the capitalized cost in the area, in the time period of the construction of an asset. Pre-construction and post-construction will be a revenue. And during the construction, it will be deducted from the capital cost in our asset, from the asset. How it is going to be done? They are telling us that the funds were required immediately. Hudson invested 3 million. 3 million has been invested at 4% from 1st October 2002 at the start of the year until 31st January 2003. So this amount is going to be our interest income, interest received. It is also going to be deducted from the Capital expenditure. How much it is going to be, students? $3 million multiplied by 4%. How many months? October to January. October, November, December, January. They say also mining commenced on 1st September 2003 and is expected to continue for 10 years. Anyhow, we are going to look that later. So how many months interest is there? Multiply by 4 divided by 12. Is it all going to be deducted? Is it all going to be deducted, students? Is it all falling during the construction time period? It's all is falling under construction time period, students. Our construction is ending on 31st August 2003. So on 1st October, construction has been started and it has ended on 31st August 2003. So all of this can be deducted from the capital cost since it is falling under the construction time period. So it is going to be deducted, students. And this balance will be written under the cost of the non-current asset. How much it is calculated? First calculate this. 10 million multiplied by 6% multiplied by 11 divided by 12. Sorry? Sure. Have you calculated? 0.55? Yes, you can take 550,000 or you can take 0.55 million. And how much it is? Interest received. This is going to be capitalized. 0.04. 0.04? 0.44 is going to be deducted. So how much balance is there? 0.55 minus 0.44. 0.11 million is going to be added over here. Borrowing cost 0.11 million is going to be added. Is everyone clear up till here? Have a look up till here and then we are going to move forward.
What about the 50,000?
Which one? 50,000?
No, 50,000 on the sale of the.
Yes, which 50,000?
What's in the profit and loss? Yeah.
Yes, that one. Yes. In the finance cost, obviously, it has to be done. But in regards to the revenue income, in regards to the interest, there will not be any. There is no income because all the interest is being capitalized. The interest which has been received, all is being capitalized. It was during the construction time period. If it would have been pre-construction interest received or post-construction interest received, then it will be regarded as the finance income, interest income it will be. Over here, we do not have it. Have a look up till here and then we are going to move forward. It's not 0.44.
Your mom is already 40,000.
Yes, it's 0.04. Be careful while doing the calculations. So it will be 0.51. It's 0.51 million. The amount which is going to be capitalized as borrowing is 0.51 million. Yes, students, done. Okay, now they say mining commenced on 1st September 2003 and is expected to continue for 10 years. So obviously for 10 years, we will be taking the depreciation on it. As a condition of being allowed to construct the facility, Hudson is required by law to dismantle it on 1st October 2013. Students, in your examination, when they are giving you Y3, it means 1, Y means 1, X means 0. Okay? So, as a condition of being allowed to construct the facility, Hudson is required by law to dismantle it. Dismantling cost, present value of the dismantling cost is also going to be included in the cost. Do you remember, in the cost, we are going to recognize the dismantling cost as well. The present value of the dismantling cost will be becoming the part of the cost of a non-current asset as per IS 16. So this is what they are telling, that we are required by law to dismantle it on 1st October 2013. Hudson estimated this would cost further 3 million. So how many years after construction it has to be dismantled? It has been started on 1st October 2002 and it has to be dismantled at 1st October 2013. How many years are there? 11 years, is it? So for 11 years, we have to convert this dismantling cost into the present value. Am I right, students? So present value of dismantling cost . What is the future value? $3 million, is it? What is the formula to convert future value into the present value? Present value is equal to future value multiplied by 1 over 1 plus r raised to the power n. This one is the discounting factor. Okay, so future value is how much? $3 million multiplied by 1 over 1 plus r. R is still known to us up till this information. We are going to leave the space for that. And how much number of periods are involved over here? 13 years. It's 13. Got it? Let's move on to the next slide. As the equipment is extremely specialized, Hudson invested significant resources in recruiting and training employees. Hudson spent $600,000 on this process in the year to 30th September 2003, believing it to be worthwhile as it anticipates that most employees will remain on the project for the entire 10 years duration. So the $600,000 is also going to be capitalized. Is it? Yes, students, speak. Is it going to be capitalized?
Is it 13 years or 11 years?
Which one? 11 years.
Only for 13 years.
Sorry. 11. I told 11 years. Okay, tell me about this training cost of 600,000. Is it going to be capitalized? Students, training costs are never capitalized. Training costs are never capitalized because we cannot control employees. Even if we are training the employees, they have not become our assets. Is it? Because they can be retained, they cannot be always retained in the organization. They can leave the organization at any time. So the cost which the organization is spending on the training of the employees is never going to be capitalized. It is a revenue expenditure. So 600,000 will be recorded in your SOPL. Got it? The 600,000 will be recorded as your training cost in your SOPL. That is 600,000 Is it? Okay, and Hudson has the cost of capital of 6%. That 6% is going to be added over here. 6% means 0.06. So what is the present value of dismantling calculated? Let me know. It was 3 million. Calculate. You have to calculate. I do not have scientific calculators, students. One point. Tell me the full value because it's in millions. So you have to write the full value. How much?
1.58036256.
This is the total value. 1.58036256 because you are writing in millions. That is why you have to write all. Now, is this going to be added to the cost of the asset? Regarding dismantling, it's an important point. This will be tested to you from yourself in the examination. Is this the cost which we are going to add in the cost of an asset? Or shall we have to add something more in regards to dismantling? Students, think about the concept. This is the present value of the amount which we have to spend in the future. When this amount is going to be capitalized only, it means that this amount is going to remain the same in our books of accounts, but when we are going to reach the future, this amount would not be necessary to fulfill $3 million. It's only half of that. Is it? When we are converting the future value into the present value means that in the future, the value of the money is going to decrease. In future, 3 million would be equal to $1.5 million right now at the moment. So in the future, we cannot give this amount only for dismantling. We have to give 3 million. That is why every year we are going to unbound the discount. This discounting factor we have applied, we are going to eliminate this discounting factor every year. Every year we will be converting this present value to the future value. Because in future we have to make this $1.5 million our $3 million. Got it? So when we are discussing about dismantling cost, when you are going to recognize dismantling cost, do recognize the interest together with it as well. How much interest we are going to take on it? 6%. How much it is? This is known as unbounding of discount. This discount is going to be added every year in our cost, and together with that, it is going to be unbounded in our SOP. Got it? How much it is?
0.0948 2175456.
Oh my God.
456.
456? Okay. Add both of these values and these will be added in your cost. Dismantling cost. How much? Up to 6 digits you can take, okay? No need to write all of them. So do add both of these and this will be total dismantling cost which you have to add in your cost. Yes, how much it is? Both will be written in the cost and this one will be written in the finance cost. This is the interest, okay? Revenue interest. So in the finance cost over here, you can add this amount as well. 0.0948217, okay?
1.75.
1.675. 18433. Up till here we can take. So this will be your cost. Have a look at the question up till here.
You are
Sorry,
the favor.
which one? This one?
Yeah.
Yes, this one is added. Dear students, now what we have to do, because we have taken a loan, we have to write this loan in our SOFP. This is the treatment under SOFP. In non-current assets, we are going to write this amount. Together with that, we have to write the loan amount as well in our SOFP. So loan is also going to be written as 10 million. Loan of 10 million is going to be written over there. And since we have paid all of the interest on 30th September 2003, the 6% interest was paid on 30th September 2003. That is why there is no accrued interest. Okay, so no further liabilities arising in the case of interest. So this is the whole scenario. So in this particular question, we have discussed about IAS 16 and IAS 23. Shall we move on, students?
Yes, miss.
These are very important adjustments which are going to be asked to you in the examination. So be careful whether you are clear about these or not. Okay, now students, this is the end of the chapter. This question is the practice question, understanding number 11. So in understanding number 11, we have so many questions. Okay, so this will be forming the revision for all of the chapter. Understanding number 11, what is the revaluation surplus that will be recognized in the financial statements in respect of this property? An entity purchased a property 15 years ago at the cost of $100,000 and have been depreciating it at the rate of 2% per annum on the straight line basis. The entity had the property professionally revalued at $500,000. So it has been a revaluation. Students, when we do revalue a property under IAS 16, what is an accounting entry which we need to pass? Who is going to tell me the accounting entry which we do pass for revaluation? Very good. Debit non-current asset. Non-current asset, cost account. Then excellent. Very good. Debit, accumulated, depreciation account, and credit. Excellent. Very good. If you do want to write these key points somewhere, you can. Credit revaluation surplus. When we are recording the amount of revaluation for non-current asset cost account, it's the difference between revalued amount and cost. Is it? Over here in front of revaluation surplus, the amount which we are recording is the difference between revalued amount and carrying value. Is it? And accumulated depreciation is the total depreciation which we have taken till date on the asset which is being revalued. So an entity purchased a property 15 years ago at the cost of $100,000 and have been depreciating it at the rate of 2% per annum on the straight line basis, the entity has had the property professionally revalued at 500,000. The difference between the cost and the revalued amount has to be written in the first. Is it the difference between the cost and the revalued amount? How much difference is there? 400,000. Total accumulated depreciation. Now we have to calculate how much accumulated depreciation will be there. Calculate and tell me. Sorry. How much per year depreciation is there? 100,000 multiplied by 2%. 20,000, and we have to take it 20,000. What? 2%.
Or 2,000.
2,000. 2,000 we have to take for how many years? 15 years. So how much total depreciation, accumulated depreciation will be there? 30,000. 30,000 accumulated depreciation will be there. You can take the total and you can simply credit it, or you can calculate the capital value first and you can take the difference with the revalued amount and then you can write it. So it is going to be 430,000. So they are asking you that what is the revaluation surplus that will be recorded in the financial statements in respect of this property. So which one are you going to record? 430,000. Got it? This amount you have to record as your in the revaluation surplus. And it will be going at one more place where if it's an investment property, then this will be going to the statement of profit or loss, revaluation gain. If it's IAS 16, then it is going to be in the statement of other comprehensive income. Okay. So 430,000 is your answer. Yes, my online students, are you cleared?
Yes, ma'am.
Okay, now question number 2 is there. The requirement of the question is that what double entry will need to be made to record the revaluations of the buildings A and B. Simply, we do know that whenever the revaluation is going to happen, the accounting entry is non-current asset cost account debit accumulated depreciation credit revaluation surplus. But in regards to the building A and B, what accounting entry has to be passed? Let's see. An entity owns 2 buildings A and B, which are currently recorded in the books at current amounts of 170,000 and 330,000. The carrying amounts are 170,000 and 330,000 respectively. Both buildings have recently been valued as follows. Building A 400,000 while building B is 250,000. For one building there is a revaluation gain, for the other building there is an impairment. Is it? The entity currently has a balance on the revaluation surplus of 50,000, which arose when building A was revalued several years ago. Building B has not previously been revalued. Students, what are we going to do? What double entry will need to be made to record the revaluations of the buildings A and B? Tell me. Solve this question on your own and tell me yes. Very simple question it is, students. Students, the cost is not given to us. Only the carrying amount and the revalued amount is given. So regarding the first portion of the accounting entry, we are blank. We do not know that how much increase in the cost is going to be there. But we can calculate about the revaluation surplus, is it? So they are telling us that for building A, the carrying amount has been 170,000 and its fair value has now been 400,000. It means that how much revaluation gain is there in regards to building A? How much it is? 230,000. 230,000 is the revaluation surplus. Am I right? So in credit, can we write? Students, in credit, revaluation surplus. Can be 230,000. Is it? It is for which building? For building A. The difference is 170,000 and 400,000. 400,000 minus 170,000. So it's 230,000. Then they say for building B, the carrying amount has been 330,000 and its revalued amount is 250,000. It's a loss. Am I right? How much loss is there? 330,000 minus 250,000. 80,000 loss is there. Where do we record the impairment loss straight away? In SOPL. Am I right? So loss is going to be debited. Profit or loss is going to be debited with how much loss? Sorry, how much it has been? 80,000? 80,000. And we have to debit, obviously, non-current asset cost account, which we do not know how much it is. So we can just take a difference of it to 30,000 minus 80,000. How much it is? 150,000? 150,000. So this will be our account. So which one it is? Option A is the right one. Shall we move on? Okay, now question number 3. What is the depreciation charge to the statement of profit or loss for the year ended 31st March 2001? On 1st April 2000, students at the year ending date is 31st March 2001. It means that the year starting date has been 1st April 2000. Is it? 1st April 2000 has been the year starting date. So on 1st April 2000, at the start of the year, Slow and Steady company held non-current assets that cost $312,000 and had accumulated depreciation of $66,000 at this date. During the year ended 31st March 2001, Slow and Steady company disposed of non-current assets which had originally cost $28,000 and had the carrying amount of 11200. Slow and Steady company policy is to charge depreciation of 40% on the reducing balance basis, with no depreciation charged in the year of disposal. Okay, the first policy is that they are going to charge the depreciation of 40% on reducing balance basis. It means that every year on the carrying value, the depreciation is going to be charged. Moreover, they are also telling us that in the year of the disposal, no depreciation is going to be charged. So what is the depreciation charge to the statement of profit or loss for the year ended 31st March 2001? Can you calculate it quickly? On the carrying value, it has to be calculated. So at the start of the year, the cost has been 312,000. Is it? 312,000 has been the value at the start of the year and had an accumulated depreciation of 66,000 at this stage. At the start of the year, the accumulated depreciation has been 66,000. So this is going to be the carrying value at the start of the year. Is it? Cost minus accumulated depreciation. How much it is? 246,000. Moreover, they have also told us that there will not be any kind of depreciation on the disposed of asset. In the year of disposal, there will not be any depreciation. So we can deduct the carrying amount of the disposed asset as well. How much carrying amount of the disposed asset has been there? 11200. Is it? Because there is no depreciation on that disposed asset. So when we are going to calculate the depreciation, we are going to deduct this amount. From the carrying amount, we can simply deduct the carrying amount of 11200. How much is the remaining amount? 246,000 minus 11200. 234,800. On this amount, now we can take the 40% depreciation. How much depreciation charge is there? 93920 is the depreciation charge for 31st March 2000. Have a look at this question, students.
What about the gain or
Sorry,
the non-current asset?
which one?
28,000 non-current asset.
28,000, where is current asset?
Non-current asset.
Where is 28,000?
Yeah.
That is the cost. That is the cost of the disposed of asset. So we will simply be deducting the carrying amount of that asset. First, we are going to deduct the cost, and then we have to deduct the accumulated depreciation as well, because we are concerned about the carrying amounts. Carrying amount is the value which is actually present in our books of accounts at the end of the year.
What do you do?
No, nothing. That is the cost. The original cost of the disposed of asset has been 28,000, and its carrying amount at the time of the disposal was 11200. So you are going to deduct this one. And you badly need to revise F3. Shall we move on, students? Okay, now students, question number 4 is there. May I erase it? A building contractor decides to construct an office building to be occupied by his own staff. Tangible non-current assets are initially measured at cost. Which two of the following expenses incurred on the building or by the building contractor cannot be included as the part of the cost of the office building? Tell me, see this question and tell me which two of the following expenses incurred by the building contractor cannot be included as the part of the cost of the office building. Hamza, are you attending the class by 2 different IDs?
Yes, miss.
Is everything
No,
fine?
no, I just joined the meeting with another ID because my mobile Zoom is not working properly. It's
Okay.
like, yeah.
Okay. Okay, students, interest incurred on the specific loan taken out to pay for the construction of the new offices. Is it going to be included in the cost? It is going to be included. Direct building labor cost. Is it going to be included in the cost? It will be included. In the cost of the construction, obviously it will be included. Direct building labor cost, it will be included. A proportion of the contractor's general administration cost. Is this going to be included in the cost? No, it will not be included. So the first one is this one. It is not going to be included. Then hire of plant and machinery for use on the office building site. Is it going to be included under IS 16? Yes, it will be included. Hire of the plant and machinery for use on the office building site. Students, keep this thing in your mind that when you are hiring any kind of special equipment which will be used to construct the building, it will be included in the cost. So hire means rent. Hire of the plant and machinery for use on the office building site, it will be included in the cost. Additional design work caused by the initial design errors, it will not be included in the cost. There is a wastage. And delivery cost in getting the raw materials onto the site, this will be included. All the costs necessary to bring the asset at its present location will be the part of the cost. So C and E would not be becoming the part of the cost. Okay, number 5. The purpose of depreciation is to, which of the following is the right one, students? Have a look at all the 4 options and tell me the right answer. Students, when you are doing these sort of the questions, these are very helpful because in the examination, they are going to check you on these particular points. In the full-fledged questions, they can give you any of the cost, and over there you will be stuck if you do not know that which has to become the part of the cost and which has not. Okay, question 5, which one is the right answer? The purpose of depreciation is to Option C is the right one, is it? Which one is the right answer, students? Sorry? D? Yes, Rahul? Samia? Hizar? No? Yes, Ali? D? Sharifa?
Yeah, I could.
Option A is the right one, students. It's the definition of the depreciation. Allocate the cost less residual value on the systematic basis over the asset's useful life. They are telling you the formula. Cost minus residual value divided by estimated useful life of the asset. B is not the right one because write the asset down to the realizable value each period. No. Do you do this in IS 16? Do you write the asset at its realizable value at the end of each year? No. It is not depreciation. Accumulate a fund for the asset replacement. This is what the normal persons do think. That depreciation is being taken so because we are setting aside an amount of a particular amount we are setting aside so that we can replace the asset. This is not so. Recognize that asset lose value over time. It's not the wear and tear in the value of an asset because we are using the matching concept. That is why we are taking the depreciation. So option A is the right answer. Allocate the cost less residual value on the systematic basis over the estimated useful life of the asset. Okay. Question number 6. How much interest should be capitalized as the part of the cost of the asset? Now this should be non-trivial. It is IS 23 again. We have recently discussed it. An entity uses funds from its general borrowings to build a new production facility. Details of the entity's borrowings are shown below. $10 million, 6% loan, $6 million, 8% loan. The entity used $12 million of these funds to construct the facility, which was under construction for the entire year. So how much interest should be capitalized as a part of the cost of the asset? Students, we have discussed in IS 23 when the organization is taking a loan from the multi-sources, then we have to take the average in order to calculate the rate of interest. So out of 16 million, only 12 million has been used in order to construct the facility. Calculate the rate of the interest and tell me how much interest should be capitalized. How much rate of interest is there, students? How are we going to calculate it? We are going to take the average. $10 million multiplied by 6%, is it? Plus the other loan is $6 million and the rate of the interest is 8%. Divided by total amount of loan is $16 million. How much rate of interest is there? 0.6 something it was. Calculate and let me know. 0.0675. It means that 6.75% rate of interest is there. And this rate of interest will be applied on the $12 million of loan, which is actually used to construct the facility, not on all of the loan. We are using only 12 million out of the total loan being taken on the construction of the facility. So how much it is? The interest which is going to be capitalized is here. $0.81 million is going to be capitalized as the interest in your cost of the non-current asset. Clear? Shall we move on? Okay, now students, question number 7. What is the deferred income balance at the end of the first year? Deferred income arises in the case of the grants. We had discussed about grants as well. Government grants. You remember? Which IAS is there? 6, 16, 20. I guess 20 government grants, okay? A manufacturing entity is entitled to grant of $3 million for creating 50 jobs and maintaining them for 3 years. Okay, 3 million grant is for 3 years. So each year, how much will be taken to the revenue, students? 3 million is for 3 years. So 3 million divided by 3 years, 1 million is going to be taken as the revenue for the grant. All of the 3 million will not be taken to our SOPL as a grant. Only the matched part is going to be taken. $1.5 million is received when the job was created, and the remaining 1.5 million is receivable after 3 years. Now, students, the condition is that out of 3 million for 3 years, every year $1 million will be taken to the revenue. Is it? But they are telling that 1.5 million is received when the job was created, and the remaining 1.5 million is receivable after 3 years, provided that 50 jobs are still in existence. Now, 1 million is revenue. It means that 2 million is deferred income. Is it? Is it the one which we are going to write it in the liability as per the concept? Am I right? But they are telling that 1.5 million is received. 1.5 million is being received. It means that remaining 0.5 million will be the deferred one. In deferred revenue, at the end of the year, the balance would be $0.5 million. Got it? Because 2 million has actually to be deferred. But we have already received 1.5 million. So it means that the liability, the deferred income would be 0.5 million or 500,000. At the end of the first year, the balance would be 0.5 million or 500,000. Students, after completing this question, we are going to have a break. Okay. Question number 8. What should be recorded in the financial statements? On 1st January 2001, SRAI received 2 million from the local government on the condition that they employ at least 100 staff each year for the next 4 years. On this date, it was virtually certain that SRAI would meet these requirements. However, on 1st January 2002, due to an economic downturn and reduced consumer demand, SRAI no longer needed to employ 100 staff. The condition of the grant required full repayment. What is going to happen? Now the grant is going to be reversed. On 1st January, the grant of 2 million has been received. Is it? On 1st January, the grant of 2 million has been received from the local government on the condition that they employ at least 100 staff each year for next 4 years. And that 2 million has to be recognized as the revenue over the period of 4 years. It means that every year 0.5 million has to be recognized as the revenue. Every year 0.5 million and the remaining 1.5 million will be deferred. Is it? The next year again 0.5 million and then 1 million is going to be deferred. But they say on this date, on 1st January 2001, at the time of taking grant, on this date it was virtually certain that SRAI would meet these requirements. However, on 1st January 2002, soon after 1 year, what happened? Due to an economic downturn, they were not able to meet the requirements. What does that mean? That after first year, soon after first year, they have to repay all of the grant. Is it? So what is going to happen? Are we going to reverse all of the grant? At the end of the first year, out of 2 million, how much has been recognized? 0.5 million. Is it? 500,000 has been recognized. And now at 1st January 2002, when we have come to know that we are not able to meet the requirements, are we going to reverse all of the grant or only remaining 1.5 million? Or only 1.5 million? That is 1,500,000 is going to be reversed. Yes, students? Only 1.5 million is going to be reversed, students. Getting it? So whenever in the exam conditions you have come to know the previous one is not going to. What we are going to do? The first case, reduce the deferred income balance by 1,500,000. See the options and tell me what is the right answer then according to this. Which one? Okay, any other? Is it not option? Yes, it's not option C. Because the full cannot be reduced. Option D, it cannot be option D. Again, they are telling reduce the deferred income by 20,000 and recognize the gain in the financial statements of 500,000. Option A, reduce the deferred income balance by 1,500,000. Is it true? Yes, we are going to reduce the deferred income balance by 1,500,000, but it's not complete. Because reduce deferred income by 1,500,000 and recognize the loss in the financial statements of 500,000. The one which we have already recognized in SOPL obviously is going to be reversed. Deferred income, which we have recorded as the liability, is going to be reduced by 1,500,000, that is 1.5 million, and the amount of the grant which we have recorded as the revenue is going to be reversed as well. What we are going to do, this amount 0.5 million which we had recorded as revenue will be debited in SOPL. This is what we are going to do. This is the first case. On the other hand, remaining $1.5 million which we had recorded as the deferred income. Students, where do we record the deferred income? In our liability in SOFP. That is going to be reversed. Got it? This is going to be eliminated. This is going to be the treatment. So option B is the right one. Very good, Rahul. Reduce deferred income by 1,500,000. Recognize a loss in the financial statements of 500,000. Clear, everyone? Shall we move on? Have a look at this question once again. Students, in the next lecture, I would like to take a test from you people. I will write the standards about which I will be taking a test, okay? Okay, I'm moving on, students. Question number 9. Calculate the profit or loss on disposal under both the cost and fair value model. Students, whenever you have to recognize a gain, profit or loss on disposal, which two values do you take a difference for? Which values do you compare? When you are calculating a gain or loss on the disposal of a non-current asset, the two values which you need to compare are carrying value and sale value. If the carrying value is more than the sale value, it's a loss on disposal. If the sale value is more than the carrying value, it's a profit on disposal. Profit or loss on the disposal of non-current asset as per IAS 16 will be recorded in the statement of profit or loss. Okay? Either it's a profit or a loss on the disposal, it will be recorded in the statement of profit or loss. So which two values you have to compare in order to calculate gain or loss on disposal? Carrying value and sale value. So calculate the profit or loss on disposal under both the cost and fair value model. An entity purchased an investment property on 1st January 2003 for a cost of 3.5 billion. Okay, so it's IAS 40. Under IAS 40, if we are recognizing, if we are taking the cost model, then there is a depreciation. Under fair value model, there is no depreciation. That is why our gain or loss on disposal will be different. So they are telling an entity has purchased an investment property on 1st January 2003 for cost of 3.5 million. The cost is 3.5 million on 1st January 2003. Had an estimated useful life of 50 years. The useful life is 50 years with no residual value. And at 31st December 2005, how many years after the purchase? 2003, 2004, and 2005 after 3 years of the purchase. At 31st December 2005 had the fair value of $4.2 million. At 31st December 2005, it had a fair value of $4.2 million. And on 1st January 2006, on the same date you can consider. 31st December 2005, 1st January 2006. On 1st January 2006, the property was sold for the net proceeds of $4 million. Students, if fair value model has been used, if say for example, fair value model has been used, then on 31st December 2005, the fair value has been how much? $4.2 million. Is it? And at that day, the sale value is for how much? $4 million. Is it a profit or loss? Sale value is lesser than the fair value. Am I right? It's a loss. It's a loss on disposal if fair value model has been used. How much loss? $0.2 million. If it would have been cost model, then carrying value has to be compared with the sale value if the cost model was have been used. If the cost model was in use, then the carrying value has to be compared with the sale value. Sale value is $4 million, it is not going to be changed, but carrying value is not going to be the same now. How much carrying value will be there? Cost minus accumulated depreciation. Cost is how much? $3.5 million minus accumulated depreciation. Accumulated depreciation for how many years we have to take? For 2003, for 2003, for 2004, and for 2005. For 3 years, accumulated depreciation has to be taken. The depreciation was taken on straight line basis for 50 years. Is it? 3.5 divided by 50 because no residual value is there. For how many years we have to take depreciation? For 3 years. 3, 4, 5. Is it? So how much accumulated depreciation is there? Calculate it, deduct it from 3.5 million to calculate carrying value. 3.29 is the carrying value. 3.29. Sure. Now compare it with the sale value. It's a profit or loss? It's a profit since sales value is higher than the carrying value. How much profit is there, students? $0.71. 3.5. Let me just recheck it. Multiply by 3. It's 3.5. It's 3.29. Yes, it's $0.71 profit. It's a profit. So if cost model has been used, there must be a profit of $0.71 million. If fair value model would have been used, there is a loss of $0.2 million. So negative, it's loss. Is it, students? So which option is the correct one? Option A is the. Shall we move on? Clear, everyone? Sure? Okay, I'm not erasing it. If you want to write it later, you can. Question number 10. What values would go through the statement of profit or loss in the year? An investment property with a useful life of 10 years was purchased by Acorn on 1st January 2009. So the property with a useful life of 10 years has been purchased on 1st January 2009 for $200,000. The cost has been $200,000 on 31st December 2009. Soon after 1 year, by 31st December 2009, the fair value of the property had risen to $300,000. Students, it's investment property. So if there is a gain, there is a gain. Can you see that there is a gain on revaluation? Where are we going to report that gain? Statement of other comprehensive income, statement of profit or loss. Under IAS 40, the gain, revaluation gain will be reported in statement of profit or loss. Okay. So investment property with the useful life of 10 years was purchased by Acorn on 1st January 2009 for $200,000. By 31st December 2009, the fair value of the property had risen to $300,000. It means that $100,000 revaluation gain would be taken to statement of profit or loss. Account measures its investment properties under the fair value model. So if it's a fair value model, are we going to take a depreciation? Very good. We are not going to take any depreciation under fair value model. So depreciation will be C. So which option is the correct one? Which values would go to the statement of profit or loss? Option C is the right one. Gain of 100,000 and depreciation of 0. Option C is the right one. Okay, now question number 11, the last question for this chapter. Question number 11. May I raise it, students? With regards to borrowing costs relating to specific borrowings used for the construction of a qualifying asset, match the description to the correct accounting treatment in the table below. Interest earned on the investment of surplus borrowings before construction period begins. Where do we write it? Included in the calculation of the non-current asset? It's before the construction period. No, so we are not going to include it in the calculation of the non-current asset. Only the interest which is earned during the construction period will be included in the calculation of the non-current asset. Investment income? Yes, it's investment income. It's interest earned, investment income. Finance cost? No. The first one is investment income. The second one, interest incurred after the construction period has ended. Is it included in the calculation of the non-current asset? After the construction period? No. Pre-construction and post-construction will not be capitalized. Investment income? Is it interest income? So no investment income. Finance cost? Yes, it is an interest cost. In SOPL, it will be recorded. Interest incurred during the construction period. Yes, it will be included in the calculation of the non-current asset. And interest earned on the investment of surplus borrowings during the construction period. Yes, it will be included in the calculation of the non-current asset. So students, with this, we have finished our chapter. Now in the next lecture, the standards which I will be taking the test for IS 16, IS 40, IS 23, and IS 20. About these 4 standards, I will be taking the test. Okay. Now, students, we can have a break of 30 minutes and then we are going to resume class. Okay, students, you have to do the understanding number 10 and 11 as your homework also. Do these understandings from your homeworks. And then we are going to start our next chapter after the break. So around 20 to 25 minutes, we are going to resume the class. Okay, online students?
Okay, miss.
Okay, ma'am.
So students, online students, we are going to resume the class now. Yes, students. Shall we resume the class? Fine for you?
Yes, miss.
Yes, online students? Okay. Now, students, the chapter which we are starting now is chapter number 3. It's a very small chapter. And the standard which we are going to discuss in this chapter is intangible assets. Intangible assets, as we do know that the standard which deals with intangible assets is IS 38. In our first lecture, we had discussed about the definition of assets. Anything which is used in an organization in order to generate economic benefits is known as an asset. Under asset, we have 2 classifications, non-current assets and current assets. Non-current assets are those which will be used for the period of more than 12 months in an organization to generate economic benefits. And current assets, Those assets which will be used within an organization for the period of lesser than 1 year are current assets. Under non-current assets, we had discussed about two classifications then, tangible non-current assets and intangible non-current assets. Tangible non-current assets are those which are having physical existence. Those assets which can be seen or touched are known as tangible non-current assets. Under tangible non-current assets, we have discussed two famous standards, IS 16 and IS 40. Now it's time to discuss about the second category of the non-current assets, that is intangible non-current assets. Intangible non-current assets are those assets which do not have any physical substance, which we are not able to see, which we are not able to touch, but still they are helping the organization to generate economic benefits. The standard which deals with intangible assets is IS 38. There is one more standard which is going to deal with one category of the intangible assets, that is IFRS 3 business combinations. One intangible asset we are going to discuss in IFRS 3 business combinations, that is goodwill. Goodwill is one of the intangible assets, but here in IS 38, we do not discuss goodwill. We are going to discuss goodwill in IFRS 3. Now we are going to start this chapter. In this chapter, students, we are going to discuss about intangible assets, primarily IS 38. We are going to know that what are intangible assets as per IS 38. How are we going to recognize them in our books of accounts, and what is the concept of amortization and how it is related to depreciation in IS 38. We are generally going to discuss about goodwill. As I told you that goodwill is one of the intangible assets, and obviously we are not going to discuss goodwill in IS 38, but generally they will be telling you in this chapter that goodwill, what is goodwill, which type of goodwill is known as an intangible asset, what is the definition of it, what is the concept of the positive goodwill, where is positive goodwill going to be recognized, and what is the concept of the negative goodwill, how do we recognize the negative goodwill. So general discussion of this part is also going to be done in this chapter. Together with that, under IS 38, one of the important intangible assets is development expenditure also. So we are going to learn about the research and development expenditure in regards to IS 38. How do we recognize research and development cost in the organizations in our financial statements? What is the definition? What is the accounting treatment? And how do we amortize our development expenditures? We are going to discuss in this chapter. I will be discussing this chapter little bit quickly because I do assume that you have already gained knowledge from F3 in regards to IS 38. So IS 38, the definition of intangible assets as per IS 38 is an intangible asset is an identifiable non-monetary asset without physical substance. IS 38 tells us that an asset will be known as an intangible asset if it is having three characteristics in it. An intangible asset is an identifiable non-monetary asset without physical substance. So three characteristics are identifiable, non-monetary, without physical substance. So we do know about the third characteristic very much in detail, that intangible assets are those which do not have physical substance. We are not able to see them. We are not able to touch them. So simply, intangible assets are in the kinds of the rights, in the kinds of the licenses. So licenses or rights are not going to be seen. We can see the license, but on the basis of that license, what is the thing which is helping us to generate economic benefits? That is a right which we are gaining by taking a license. So intangible assets, the first characteristic is that they will not be having any physical substance. The second characteristic of IS 38 intangible assets is that they are identifiable. They are separately distinguishable from the other assets of the organization. If we are not able to distinguish an intangible asset from the other assets of the organization, then it is not intangible asset under IS 38. The third characteristic is that intangible assets are non-monetary asset. Non-monetary asset doesn't mean that they will not be having any money value. Non-monetary asset means that they will not be having a readily available market. For other assets, we do know that if we do want to purchase a seat, furniture, camera from the market, we do know that what is the price of these things, because there is a readily available market for these items. For intangible assets, there is no readily available market. They are not going to be having any monetary value because they do not have any readily available market for these. So 3 characteristics of the intangible assets is that they are identifiable, non-monetary, without any physical existence. What are the items which can be included under intangible assets? The first one is licenses and quotas. The second one is intellectual property like patents and copyrights. Patents, as we have discussed earlier, patents are specific kinds of formulas which are used in order to prepare a product. Copyrights is the right which specifically gives a right to one particular entity to produce, to what we can say, to print the certain documents. So rather than instead of that particular entity which is having a copyright, no other entity would be able to print the particular document. So these are going to be regarded as intangible assets and brand names. If, say, for example, over a certain period of time, an organization has built up a brand name, that is an internally generated brand name. That is not going to be considered as, it will be considered as an intangible asset, but we are not going to recognize it. So under this brand name, we are going to discuss further things as well. Anyhow, brand names are generally intangible assets because when the organization is building a certain brand name, on the basis of that brand, it is able to generate more economic benefits. It is kind of a goodwill, it's a kind of a good repute in the market. Then trademarks. Trademarks are also logos, or trademarks are also the kind of the intangible assets. Then students, they say for an asset to be identifiable, as we were discussing that what is the meaning of identifiable, we had discussed generally that identifiable means that an asset is distinguishable from the other assets of an entity. So for an asset to be identifiable, IS 38 intangible asset states that it must fall into one of the 2 categories. It is separable. The asset can be bought or sold separately from the rest of the business because it is going to be distinguishable from the other assets of the entity. Then we are able to buy it or sell it on its own in the market. We do not have to buy it or sell it together with the existence of the other assets. So on its own, it can be bought or sold. And it arises from legal or the contractual rights. This will arise as part of purchasing an entire company. This will be looked at further in the consolidated financial statements chapter. So the intangible assets should be arising from the legal or the contractual rights. This will arise as a part of purchasing an entire company. If, say, for example, you are purchasing an entire company, and together with that, certain assets you are purchasing, like their goodwill, the goodwill of the company which you are purchasing, their brand name, the brand name of the company which you are purchasing will also be considered as the intangible asset. So it is going to be arising from the legal or the contractual rights, and we are going to discuss it towards the ending of our book in consolidated financial statements as well. So IFRS 3 business combinations will be discussed mainly towards the end of your book when we are going to discuss the consolidated financial statements. So 2 things are going to make an intangible asset and identifiable. One, that is, it is separable from the other items of the assets in the organization. We are going to certainly distinguish it. And it is going to arise from any kind of legal or the contractual rights. It must also meet the normal definition of an asset. For any kind of intangible asset, it's necessary that first it is meeting the definition of asset. Any kind of intangible asset cannot be an intangible asset if it is not meeting the definition of an asset. So what is an asset? Controlled by the entity as the result of the past events, a resource from which the future economic benefits are expected to flow. Students, I have seen so many students who up till now do not know that which things are going to be considered as the assets of the company, those which are owned by the company or those which are controlled by the company. The thing is that asset is anything which is controlled by the entity, either purchased or not, either in the ownership of the company or not. Even, say, for example, if we are having a long-term lease, that leased asset is also our asset, is it? So it is not necessary for an asset to be owned by an entity. If it is just controlled by an entity, it is going to be considered as our asset. So it must also meet the normal definition of an asset, which means that it must be controlled by the entity as a result of the past event. Past event can be any event which is legally binding the company, any kind of agreement. And then a resource from which the future economic benefits are expected to flow, either from revenue or cost saving. Now, this point is again that if we are purchasing an intangible asset, it will always helping us to increase the revenue. It is not so. It is not every time possible that whenever you are purchasing an intangible asset, it will be helping you to generate revenue. It will be helping you sometimes to reduce your costs as well. So the thing behind this concept is that intangible assets sometimes will be helping you to increase the revenues, and sometimes they will be helping you to decrease the cost. In both the cases, they will be considered as your intangible assets. Now, students, the second thing, first part of the intangible assets is now finished. We have discussed about the definition of an intangible asset. An intangible asset is an identifiable, non-monetary asset with no physical substance. Now we are going to discuss about the recognition of the intangible assets in the books of accounts. Which are the criteria which have to be met in order to recognize the intangible assets in our books of accounts? As per IS 16, as per IS 40, the recognition criteria has already been discussed. The same recognition criteria applies to IS 38 as well. In order to recognize any kind of non-current asset in our books of accounts, two criteria have to be met. What are those criteria? It is probable that the future economic benefits attributable to the asset will flow to the entity, and the cost of the asset can be measured reliably. So this recognition criteria is the same for IS 38 as well. Number one is it is probable that the future economic benefits will inflow to the entity, and those future economic benefits could be in the form of inflow of the revenue and in the form of cost savings as well. And the cost of the asset can be measured reliably. We would be able to measure the cost of an asset which we have to recognize in our books of accounts. Cost means purchase price and any cost which is necessary to bring the asset in its present location and condition. So if these two criteria are met, then we are able to recognize the intangible asset in our books of accounts as per IS 38 also. So they say, to be recognized in the financial statements, an intangible asset must meet the definition of an intangible asset and meet the recognition criteria. What is that? It is probable that future economic benefits attributable to the asset will flow to the entity, and the cost of an asset can be measured reliably. If these criteria are met, the asset should be initially recognized at cost. Now, my dear students, for IS 38, again, for IS 38 also, we have initial measurement and we have subsequent measurement. Initially, if the recognition criteria is being met, then if these criteria are met, then asset should initially be recognized at cost. Initially, we have to recognize the intangible asset at its cost. Subsequently, we are going to discuss later, but you should be knowing that subsequent measurement can either be using a cost model or a fair value model. Fair value model is normally not applied in the case of intangible assets. Why it is not applied? Because what is fair value? It's the market value of an asset. And for most of the intangible assets, readily available market is not present, is it? This is what we have discussed. So normally for most of the asset, fair value model is not going to be used, and we are concerned about cost model in IS 38 also. When we are adopting a cost model for subsequently measuring intangible assets, then it will be measured at cost minus accumulated amortization minus subsequent impairment losses. This you can write. Okay, now students, we have discussed about the initial recognition of IS 38, that if these two criteria are being met, then initially we can recognize the intangible asset at its cost. Now, purchased intangible assets. One more thing you have to be cleared about. that the purchased intangible assets are going to be recognized only. Internally generated intangible assets are not going to be recognized in our books of accounts. If, say, for example, we have purchased a goodwill, then it can be recognized as an intangible asset. If we have purchased a brand, then it will be recognized as our intangible asset. If we have purchased any kind of franchise, then it will be recognized as an intangible asset. If we have internally generated any intangible asset, say, for example, internally with the passage of time, the business has made a certain repute in the market, that goodwill is not going to be recognized as intangible asset in our books of accounts. Over the passage of time, if the business has made a strong brand name, that brand name will not be recognized as an intangible asset as per IS 38. So only purchased intangible assets will be recognized as intangible assets as per IS 38. So they are telling us if an intangible asset is purchased separately, such as licenses, patents, brand name, it should be recognized initially at cost. Any kind of internally generated intangible assets will not be recognized. Measurement after initial recognition. As I told you that after initial recognition, we have two models which we can adopt, either a cost model or the revaluation model, also known as fair value model. Now they say about the cost model. I have elaborated already. How do we recognize an asset at its cost? It's cost minus accumulated depreciation minus any kind of impairment losses. Now let's see what your book says about it. The cost model. The intangible asset should be carried at cost less amortization and any impairment losses. The model is more commonly used in practice. Amortization works the same as depreciation. Students, amortization is having the same practical background as the depreciation. Amortization is taken on the intangible assets. Depreciation is taken on the tangible non-current assets. Now, students, amortization will be taken only for those intangible assets which are having a definite useful life. In the examination, if they are telling you that your intangible asset brought is going to be used for the period of 10 years, it means that it is having a definite useful life. That particular intangible asset with the definite useful life will be amortized. Those intangible assets which are having indefinite useful life, which is going to be used for infinity, obviously for those there is no amortization. So regarding amortization, you should also keep this in mind. So they say amortization works the same as depreciation. The intangible asset is amortized over the useful life with an annual expense being shown in the statement of profit or loss each year. Where do we show depreciation? In our statement of profit or loss. Where do we show amortization? In our statement of profit or loss. Together with that, students, under IS 16, depreciation is having two policies, either straight line method or reducing balance method. Over here, there is no such thing. Okay, here we are just going to take an amortization as the value of an asset, the cost of intangible asset divided by its useful life. So this is what they are telling. The intangible asset is amortized over the useful life with an annual expense being shown in the statement of profit or loss each year. An intangible asset with finite useful life must be amortized over that life, normally using the straight line method with zero residual value. An intangible asset with an indefinite useful life should not be amortized. Should be tested for an impairment annually and more often if there is an actual indication of possible impairment. Now, students, in the case of an intangible asset with an indefinite useful life, for that asset we do not know that how much useful life will be there. We are not going to amortize it. No amortization is there. But if there is an indication of impairment, if few factors internal to the organization or external to the organization are indicating that maybe the value of the asset is going down, it means that there is an indication of an impairment. So every year we are going to check for the indications of the possible impairment for an asset with an indefinite useful life. And if it is being impaired, we are going to write it at its impaired value. Got it? So this is the case of the cost model. Now regarding revaluation model, what does this say? I told you practically that we do not use the fair value model or revaluation model for IS 38 normally because there is no readily available market for the intangible assets. Now what your book says about it, let's read. The intangible asset may be revalued to a carrying amount of fair value less subsequent amortization and impairment losses. If say for example the fair value model has to be used, it is going to be implemented in the same way as IS 16 or IS 40. We can say IS 16 because amortization will be taken here. So it will be recognized at carrying value minus subsequent amortization minus any kind of subsequent impairment losses. So they say the intangible asset may be revalued to a carrying amount of fair value less subsequent amortization and impairment losses. Fair value should be determined by reference to an active market. An active market is a market in which transactions for the assets take place with sufficient frequency and volume to provide pricing information on an ongoing basis. So basically, active market is the market where you are able to purchase or sell the relevant type of the goods or services. IS 38 states that active markets for intangible assets are rare and specifically prohibits the revaluation of patents, brand names, trademarks, and publishing rights. As a guide, indicators of an active market would include the items traded within the market are homogeneous, identical ones. Prices are available to the public. Most intangible assets have value because of their uniqueness and are therefore unlikely to be homogeneous. Certain licenses may fit this model and could possibly be revalued, but most other intangible assets will not. So summarizing the discussion that you would not be using the revaluation model for intangible assets, instead you will be going for the cost model only because there is no readily available market for most of the intangible assets which you are purchasing. The most of the intangible assets are unique. Say for example, if you are purchasing a license, the licenses do not have having an active market. The same kind of the licenses do not have an active market. They are not homogeneous. All the licenses are not identical. Most of the licenses. If you have to purchase a copyright, obviously it's a unique one to certain kind of a publication. So it is not going to be having an active market. How can you know that how much value each of the copyright will be having if you are going to sell it in the market? So it is going to be no active available market for intangible assets. That is why most of the times we will be using the cost model. Now regarding internally generated intangible assets, as we have already discussed that internally generated intangible assets will not be recognized in our books of accounts. This is what they are elaborating in this slide now. They are telling generally internally generated intangible assets cannot be capitalized, as the cost associated with these cannot be identified separately from the cost associated with running the business. The following internally generated items may never be recognized: goodwill, brands, mastheads, publishing titles, customer lists. So these kind of intangible assets which are internally generated are not going to be recognized in our books of accounts. Do not consider that if these intangible assets are purchased also, they are not going to consider. They will be considered as intangible assets and will be recognized as per IS 38 if they are purchased. If they are internally generated, then they will not be recognized. So if goodwill is purchased, it will be recognized. Okay, and same is the case with the other assets as well. Clear, students, up till here? So what we have discussed for IS 38 up till now, that IS 38 is about intangible assets. It tells us that if any of the intangible asset is fulfilling a recognition criteria, it will first be recognized at its cost in our books of accounts. So initially we are going to recognize an intangible asset at its cost. Under the cost model, obviously initially we have to recognize the purchase price plus all the costs which were necessary to bring that asset in its present location and working condition. Then subsequently, after the first year of the purchase, we can either adopt the cost model or the revaluation model. If we are adopting the cost model, then we have to recognize the intangible asset at cost minus subsequent accumulated amortization minus subsequent impairment losses. If we are adopting a fair value model, then fair value minus accumulated amortization minus subsequent impairment losses. For most of the intangible assets, we will be using a cost model only. We have then discussed about amortization. Amortization is going to be treated in the similar way as the depreciation. We are going to recognize amortization in our statement of profit or loss. How are we going to calculate amortization? Cost of an asset divided by estimated useful life of the intangible asset. We are going to take amortization only for the assets with the definite useful life. Those assets which are having indefinite useful life will not be amortized, but they are going to be checked for annual impairment review. Every year we are going to check that whether there is an indication of the impairment or not. Internal or external factors can tell us that whether there is an indication of impairment. If there is an indication of impairment, we are going to check for that. If an asset is impaired, we are going to record the asset at its impaired value. This is for the assets with the indefinite useful life. Now, illustration number 1 is there, students. How should the following intangible assets be treated in the financial statements? Number 1, a publishing title acquired as a part of the subsidiary company. You are purchasing a publishing title acquired as a part of the subsidiary company. What is a subsidiary? What is a subsidiary? A purchased company in which you are having more than 50% shares. So if you have purchased a subsidiary, if you have acquired a subsidiary, and together with that acquisition, you are acquiring a publishing title as well. Will it be considered as an intangible asset? It will be, whether it is going to be recognized in the financial statements or not. Students, it depends upon that whether its value can be measured reliably or not. If we are able to get its value separate from the other assets of the company, then it will be recognized as intangible asset as per IS 38. If its value is not going to be available to us, if we are not able to distinguish it from the other assets of the company, we are not reliably able to measure its value, then it will not be recognized as per intangible asset for IS 38. Okay. Then a license purchased in order to market a new product. License which is purchased in order to market a new product, it's a specific license. It is being used to market a new product. Its value is obviously measured reliably. It is distinguishable from the other licenses, so we are going to record it as our intangible asset for IS 38. Okay. Okay, now we are going to have a short discussion in regards to IFRS 3 business combinations. IFRS 3 business combinations, we are not going to discuss in detail. Just as a part of IS 38, few things we are going to discuss over here. In detail, it will be discussed towards the last of your. IFRS 3 business combinations is being discussed over here because of the goodwill. What is a goodwill? A goodwill is a repute of the business in a market. Over the passage of time, because the business has been doing very well, that is why it will become reputed in the market. The people will start knowing that particular business. This particular repute of the business in the market is known as its goodwill. On the basis of this goodwill, now the business is able to generate more economic benefits. The big brands which you do see around yourself, and you are ready to pay more for those brands, this is because of their goodwill. This is because of the repute which they have made over the passage of time in the minds of the people. Now, as per IFRS 3 business combinations, if you are purchasing a goodwill together with purchasing another entity, then that goodwill will be recognized as your intangible asset in your books of accounts. If you have yourself generated internally your goodwill, that will not be recognized as an intangible asset. So inherent goodwill, that is internally generated goodwill, will not be recognized in your books of accounts as per IS 38. Got it? So this is what they say. IFRS 3 governs accounting for all business combinations and deal with the accounting treatment of goodwill. See chapter 18. So in chapter 18, we are going to discuss it. What is goodwill? Goodwill is defined as an asset representing the future economic benefits arising from the assets acquired in the business combination that are not individually identified and separately recognized. Negative goodwill. Sometimes, students, the negative goodwill arises. What is a negative goodwill? Can anyone tell me the formula of calculating the goodwill which we have discussed in F3? The formula of the goodwill. How do we calculate goodwill as per IFRS 3? Who can tell me? Yes, online students. Anyone? Yes, Shriva? Do you remember? Yes, Samreen, do you remember? No one remembers? How do we
I think what the parent company paid minus the net assets of the subsidiary.
Very good. It's the basic concept. Although he's not able to tell the full formula, but the basic concept is that when we are purchasing a particularly running business and we are paying more than its net assets, it means that the more amount which we are paying is because of the goodwill of the business. So when we are paying a consideration, purchase consideration to purchase a business. If say, for example, we are giving a consideration of $10 million for an already running business, but the net assets of the business purchased, net assets of the subsidiary are only for $8 million. It means that the $2 million extra which we are paying is for goodwill. When there is an already running business, when we try to purchase it, we are purchasing its assets and liabilities also. The excess of assets over to the liabilities is known as net assets. So we are purchasing the net assets of the business. Obviously, we have to pay only this amount in order to purchase a business. But sometimes we are paying more in order to purchase that business. The amount which we are paying over and above the net assets of that business is because of the goodwill, the good repute of the business which it has built over the passage of time. Sometimes we are paying lesser amount. This amount is known as positive goodwill. When we are paying more than the net assets of the business. Sometimes it can also happen that the purchase consideration which we are paying is 8 million, whereas the net assets of the business are 10 million. We are paying lesser than the net assets of the business. Now, what is happening? 2 million negative is coming. This is because of the negative goodwill. This is negative goodwill of the business. Now, negative goodwill, I am reading from here. Negative goodwill, gain on bargain purchase is treated as income. Now, the business who is paying lesser than the net assets of the business is going to treat this negative goodwill as its income in statement of profit or loss because it has paid lesser as compared to the net assets of the subsidiary. So negative goodwill is treated as income as the purchaser has paid less than the fair value of the identifiable net assets. This will be covered further in chapter 18, accounting for non-purchased goodwill. Now the goodwill which is non-being purchased is not going to be recognized. Okay. So what they say, non-purchased goodwill should not be recognized in the financial statements. It certainly exists. It is existing, but we are not able to separate it from the existing assets of the company. It is somewhere hidden in the existing assets of the company. When say, for example, our business is going to be purchased by the other business, then that goodwill is going to be materialized, if any. So it certainly exists, but fails to satisfy the recognition criteria in the framework, since it is not capable of being measured reliably. So internally generated goodwill is not going to be recognized, but if you are purchasing a goodwill, then it will be recognized as the positive or the negative. Now students, goodwill may exist because of any combination of the number of possible factors. This is general discussion how the goodwill arises, reputation for the quality of service, if the business is having a reputation, good reputation for its quality of the service, technical expertise, possession of favorable contracts or good management and staff. All these factors can increase the goodwill of the business. Purchased and non-purchased goodwill. Purchased goodwill arises when one business acquires another as a going concern. When does the purchased goodwill arises? When one business is purchasing the other business as a going concern. It includes goodwill arising on the consolidation of a subsidiary. Will be recognized in the financial statement as its value at the particular point in time inserted. Where do we recognize the purchased goodwill? Who can tell me? When we do the questions on the consolidation, where do we write goodwill? Under the head of intangible assets. In consolidated financial statements, in consolidated SOFP, we write this purchased goodwill under the head of non-current assets in our SOFP. Got it? Non-purchased goodwill is also known as inherent goodwill, has no identifiable value, is not recognized in the financial statements. So this is the summary of the things which we have discussed. Now, students, a very important part in IS 38 we are starting to discuss. That is about research and development. Research and development is a very big concern for the businesses in the modern world. Because in order to innovate, in order to make a creativity, the organizations have to spend on research and development. Research and development are not the same things. Research is any kind of planned investigation of certain things. If the organization is thinking to know about certain things, they can conduct a research. It's a planned investigation to know about few things. If, say, for example, your teacher says that you have to make an assignment and that assignment has to be based upon a research work, it means that you have to investigate few things and then you have to write an assignment. Same happens in the case of the organizations. When the organizations do want to look into certain things, they are going to conduct an investigation. All the costs which the organizations are investing, are incurring on the investigation or on the research are never going to be capitalized. They are going to be treated as revenue expenditures. They are going to be written off as soon as they are incurred. What is research? Any kind of planned investigation in order to get some knowledge. All of the costs which the organization is spending in order to investigate certain things, research costs, are going to be treated as the revenue expenditures. They are going to be written off in statement of profit or loss as soon as they are incurred. So in regards to IS 38, for research expenditures, as soon as they incur, we are going to write them off in our SOPL. Let me write it over there. Research and development. Research expense written off in SOPL. Okay, this is the first treatment. Now the second thing is development. Once the organization has gained a particular knowledge and it starts implementing it, if, say, for example, by investigation, by making a research, organization has come to know that a particular design, if it is going to be made, it is going to help the organization to reduce its cost. Now the organization is ready to develop that particular item, particular design, which obviously is going to help the organization to reduce its cost. Now this phase is known as a development phase. All the expenditures which are happening, which are being incurred in the development stage, are going to be capitalized if they are meeting certain criteria. They are not going to be capitalized if they are not meeting a certain criteria. So regarding development expenditure, capitalized as an intangible asset if meets a criteria. And what is that criteria? That criteria can be learned with the help of a mnemonic of pirate, which we had discussed in F3 as well. Development expenditure will be capitalized as an intangible asset if it is meeting this 6-point criteria, which can be learned with the help of this mnemonic of pirate. So what they say? Definition of research and development, first they are explaining. Research is the original and planned investigation undertaken with the prospect of gaining new scientific knowledge and understanding. And development is the application of research findings or other knowledge to a plan or design for the production of new or substantially improved materials, devices, products, processes, systems, or services before the start of the commercial production or use. Now, students, accounting treatment. What is the accounting treatment of research expenditure? Write off as incurred to the statement of profit or loss. As soon as the research expenditures are going to be incurred, we are going to write them off in our statement of profit or loss. Development expenditure recognized as an intangible asset if and only if an entity can demonstrate all of the following. If the organization is meeting the 6-point criteria, then it would be able to recognize the development expenditure as an intangible asset. If not, then it is not going to recognize the development expenditure as an intangible asset. One more thing. After writing an asset as development expenditure as an asset, the organization will be reviewing it continuously in the further years as well. If at any point it sees that any of the point is not being met, then it is going to write it in statement of profit or loss. It will be written off immediately. Subsequently, it will be reviewed. Once the commercial production is started, it's okay. But before to the commercial production, if it is still under the development phase, organization is going to review that whether this criteria is still meeting or not. If at any point it sees that this criteria has not been met, any of the criteria has not been met, it is going to be written off as the revenue. It is going to be written off in statement of profit or loss, all of the capitalized costs. Moreover, one more thing. Once this is written as a revenue expenditure in SOPL, then it will never be reinstated as the capital expenditure. Then we would never be able to reverse it and we'll be writing it in our SOF. Okay. So what is that 6-point criteria? P. In Pilot, P stands for probable flow of the economic benefits from the assets, whether through sales or internal cost savings. This point is important. This examination also sometimes it is coming. Probable flow of the economic benefits from the asset. When we are incurring any cost in the development, we must be knowing at that time that how much chances are there that this development expenditure will be helping us to give the economic benefits. And those economic benefits must be in the form of the increase in revenue or in the form of cost savings. Okay. Probable in accountancy means that the chances are more than 50%. Intention to I stands for intention to complete the intangible asset and use or sell it. At the time of incurring the development expenditure, the organization must be having a will, wish and intention to complete the intangible asset and then use it or sell it. By selling an intangible asset, also the organization can think or intending to generate the economic benefits. Then the third one, reliable measure of the development cost. The cost which we are incurring must be able to be reliably measured. And this is a condition for the normal intangible assets as well. So if we are not able to reliably measure the amount of the development cost, then it is not meeting the certain criteria. What is the reliable measurement? That the amount which we are spending as the development cost must be having certain evidences generated for that. There is an invoice for the particular expenses which we are incurring. Then A stands for adequate resources to complete the project. The organization must be having the technical feasibility and adequate resources to complete the project. Sometimes the organization comes to know that the development of the project will be needing more, 10 millions more will be required for that, but the organization is not having that much amount of money. It means that by not fulfilling this criteria, the organization has to write it off in their SOP immediately. Then technical feasibility of completing the intangible assets so that it will be available for use for sale. Now, technical feasibility of completing the assets, sometimes we do need certain intellectual skills or certain types of the machineries to finish the project. If that technical feasibility is not present, or if say, for example, for making or constructing an asset, that technical feasibility was present, but for selling the asset, later technical feasibility is not present, even then it will be immediately written off. So technical feasibility is also important. And the last one, expected to be profitable. The organization obviously spends an amount in the development expenditure because it is thinking that in future, it will be giving us the economic benefits inflow. If at any point the organization comes to know that this project will not be profitable, it will be running into losses, immediately it will be writing it as revenue expense in SOP. So 6-point criteria, if met, then the development expenditure will be capitalized as intangible assets. Otherwise, if any of the criteria has not been met, we are immediately going to write it off as a revenue expenditure. Okay. Now, further points which we have already discussed. What we have discussed, that if at any point in the later years, organization comes to know that any of the point is not being met, it will be immediately writing it off in the SOPL. Once it is written off in the SOPL, it will not be reinstated as the capital expenditure again. So further points, let's see. Only the expenditure meeting the criteria should be classified as an asset. Development expenditure recognized as an expense in profit or loss cannot be subsequently restated as an asset. And the third one, if an item of the plant is used in the development process, the depreciation on the plant is added to the development cost in intangible assets during the period that the project meets the development criteria. Now, if any of the asset which is being used in the process of development expenditure will also be recognized as the IS 38 intangible asset, like we have seen in the case of IS 16 as well. Any of the equipment which is being hired or being purchased for making or constructing a building or any other asset will be recognized as IS 16. So similar case is going to happen in the case of IS 38. If any of the machinery or equipment is bought in order to conduct the development expenditure will also become the part of IS 38, intangible assets. That is because the economic benefits gained from the plant in this period is only realized when the development project is complete and the production is underway. It will be taken to statement of profit or loss as amortization within the amortization of the development cost. Okay. Now, students, what is amortization? We have already discussed that what is amortization. Can I take few 10 minutes from your class? Is it fine for you? Fine for you? Up till 110? No? Okay, this slide. Amortization. What is an amortization? Amortization is similar to the depreciation. And we are going to take amortization in our statement of profit or loss. Similarly to the depreciation. What is the formula of amortization? Cost divided by estimated useful life of the asset. Amortization will be taken only for the intangible assets with the definite useful life. Now let's have a look at this understanding. How should each of these costs be treated in the financial statements of the entity? An entity has incurred the following expenditures during the current year. 100,000 spent on the initial design work of the new product. 100,000 spent on the initial design work of the new product. Students, are we going to capitalize this initial design work? 100,000 spent on the initial design work of a new product. It is anticipated that this design will be taken forward over the next 2-year period to be developed and tested with a view to production in 3 years' time. Is it going to be capitalized? No. Initial design work is not going to be capitalized. 100,000 is going to be written as a revenue expenditure in your statement of profit or loss. Second one, 500,000 spent on testing of the new production system. Yes, this will be capitalized. Testing of the new production system, which has been designed internally and which will be in operation during the following accounting year. This is the development cost. This new system should reduce the cost of the production by 20%. So it is generating the economic benefits. This 100,000 will be written as an expense in statement of profit or loss. Whereas this 500,000 will be capitalized in SOFP, it will be written as intangible asset in SOFP. So this is how both of these are going to be treated. Clear, students? Now with this, we are going to finish our lecture for today. Students, understanding number 2 and understanding number 3 are your homeworks. Understanding number 2 and understanding number 3 for IS 38 are your homeworks. Okay. Yes, students, if any one of you is having any question, please ask. No questions? Hey, sir, when are you giving your F1 exam? With F4 and F7? No, dear, you would not be able to do that. In order to give F4, F7, you have to first finish your first module.
First I'll give F1, then give.
Okay, sure. Okay, my online students.
Yes, miss.
Students, tomorrow we are not going to have a class of F4. Who is going to the expo? What about you, some reading? Not going? Okay. So tomorrow we are not going to have a class for F4. Okay? Okay, students, take care of yourselves. Online students, I'm ending the meeting now.
Okay, miss. Bye.
Goodbye.